Good evening and welcome back to Be Rich. Yesterday was a very eventful day. What happened is the consumer price numbers was expected to go up marginally from 8.5 to 8.8, and they thought this would be the peak and the Fed would raise interest rates by 0.75% as they expected, and things would all be good, and then the inflation would start to fall. Unfortunately, things didn't go by plan. The most aggressive bet was the inflation would rise by only 8.9. All of them got it completely wrong. The US CPI went to 9.1. Food and fuel is very volatile. So if you strip off food and fuel, the core inflation is at 5.95 or almost at 6. This means that inflationary pressures in America have not abated. This is no more a transitionary plan. The Fed got it completely wrong. They had no idea what was coming and they should have corrected course many quarters back. But having not done so, they are now paying the price and looking like fools. For 2 months in a row, the guidance of the Fed has completely gone wrong. The Fed has been guiding that it will increase rates at 0.5%, was forced to increase it at 0.75 in light of last month's data. In spite of it raising it 0.75, it has had no impact on the CPI prices, and therefore this quarter, where they have already guided a 0.75 increase to surprise the market, they may be forced to go the full Monty and take a 1% hike. If they do a 1% hike, you are already talking about 2.75 to 3% as the Federal Reserve rates. And this option must be in the table. If the Fed is claims as it has been claiming so far, it is going to be data dependent, then it must move in the direction that data is telling them to move. Data is now telling us that the Fed has missed the bus and the Fed is woefully behind the curve. It is now clear that the Fed is in very early stages of tackling inflation, and there is fear, justifiably so, that the Fed may chicken out and may not go the full distance when crushing inflation. This has led to a lot of knock on issues. The Fed recently introduced 20-year treasury bonds. There are 10-year bonds and then there is a 30-year bond. There is nothing in between. For nearly 3 decades, there has been no 20-year treasury bonds in the US. This is because there was no liquidity and no takers. The Fed in 2020 decided to introduce 20-year-old treasury bond. But trade has been very inactive. Very little traders have got into it and they are now showing interest in it. There is lack of appetite and lack of liquidity. Simply put, that the Fed is unable to guide the market at what price a 20-year loan should be priced. The market wants them to price it higher, but Fed wants a cheaper rate because lower interest rates means lower interest costs. Lower interest costs means more economic growth, more prosperity. Both the politicians and the Fed would love it. Unfortunately, we are now in a scenario where we have moved away from a situation of pump priming growth to a point where inflation has to be tackled at all costs. At this time, a 20-year paper would have been a great tool in the hands of the Fed so as to promote investors to buy long term bonds at slightly cheaper rates than what the 30-year bond is now trading at, so that the taxpayer benefits with lower rates over a long period of time. But the Fed being what it has been doing, supplying punch bowl at the first sign of trouble every time, it is now clear that the investors do not want to hold treasuries for a long term period, and therefore they have shunned the 20-year bond. Also, there is news coming out of the United States that more auctions for treasuries have failed than normally than what is the norm. It is now clear that a large number of treasury deals have come unstuck and have failed to go through. Recently in the US, a $570 bond was not taken in by investors because they believed that the price was too low. There is going to be pressure on the Fed to take back the 20-year-old bond because nobody seems to be interested in it. It is now clear that the market is now expecting that the Fed will increase interest rates by 1%. The 1% increase means the Fed has gone the entire year into one. That is, if the Fed normally increases interest rates at 0.25 at a time, this will roll in four interest rate hikes at a single time. This is going to push the market under severe pressure. This, along with quality rating, will make sure that there is no liquidity in the market. And if there is no liquidity in the market, funding and financing of even A grade bonds will become extremely difficult. For emerging markets, this is real bad news because their debt is going to get costlier, the value of their bonds is going to fall, and therefore they are going to pay higher interest rates. One can expect several big corporate defaults. Right now, only Revlon has defaulted, but it is now clear that companies which have large out exposures to banks and other financial institutions will begin to correct. This will put a lot of pressure on liquidity and lot of stocks will become available. The biggest pressure point is going to be felt in the private equity industry because there is no transparent price discovery mechanism and the public markets are in a terrible shape, and therefore an escape through a listing stock offer is not very attractive. It is clear that companies funded by private equity across Asia are beginning to collapse. This is an unintended consequence of the Fed tightening. If you like the content in my video, hit the like button, press the subscribe button, and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for your support to be. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.